Lending and inflation, what happens to debt in hyperinflation? 1. Introduction. Welcome back. Today's focus is lending and inflation. More specifically, what happens to your debt if inflation spirals into hyperinflation? But before answering that, we need to peel back the basics, how lending actually works for both lenders and borrowers. So what does that actually mean? First we build the structure, then we stress test it with inflation. Footnote. Understanding lending mechanics is the foundation for grasping inflation's impact on debt. 2. How lending works. At its core, lending is simple. One party hands over money. The other agrees to pay it back later. That's true whether the lender is a bank or just your neighbor. Lending is temporary ownership transfer, a loan dollar leaves one pocket, lands in another, and must eventually return with interest. The lender expects compensation for the time value of money. The borrower accepts the cost in exchange for immediate use. Think of it like renting money instead of renting an apartment. Footnote. Lending is the temporary transfer of money, repaid with interest for time and risk. Perfect. Let's continue the report and move step by step into inflation, hyperinflation, and what happens to debt. I'll keep the same format with short sentences, pauses, humor, and clear footnotes. 3. Lending from the lender's view. For the lender, a loan is an investment. They part with cash today expecting more back tomorrow. The risk is that the borrower won't pay. To protect against that, lenders charge interest. That interest is like rent on money. The longer you borrow, the higher the rent. Lenders also rely on contracts, collateral, and credit checks. So what does that actually mean? The lender wants steady cash flow, low risk, and a legal net to catch you if you run. Footnote. Lenders treat loans as investments with built-in safeguards and interest as compensation. 4. Lending from the borrower's view. Borrowers see loans differently. To them, it's not an investment, it's survival or opportunity. They borrow for houses, cars, businesses, or just to cover bills. The cost of borrowing is the interest rate. The higher the rate, the heavier the burden. Borrowers bet that what they gain today outweighs what they'll owe tomorrow. Problem is, tomorrow always comes. Footnote. Borrowers exchange future obligations for immediate use of money. 5. Inflation enters the scene. Now add inflation. Inflation is simply rising prices. The same dollar tomorrow buys less than it does today. Lenders hate it because they get paid back in weaker dollars. Borrowers love it, at least a little, because they repay debt with money that feels cheaper. Example. If your monthly payment is $1,000, but inflation makes your salary go up, that $1,000 feels smaller. The debt didn't shrink, but your ability to pay did improve. Footnote. Inflation erodes the value of money, hurting lenders but often easing borrowers' debt burden. 6. Hyperinflation, the wild card. Hyperinflation is inflation on steroids. Think Weimar Germany or Zimbabwe. Prices double, triple, or worse in weeks. In that world, debt evaporates fast. Imagine owing $100,000. If milk costs $1 million a gallon, your debt is practically meaningless. Borrowers win big. Lenders lose everything. So what does that actually mean? In hyperinflation, the rent on money becomes worthless, and contracts collapse. The money system itself breaks down. Footnote. Hyperinflation destroys the real value of debt, benefiting borrowers while wiping out lenders. 7. The human side. Sounds good if you owe money, right? Not so fast. Hyperinflation wrecks savings, wages, pensions, and stability. You might pay off your mortgage easily, but you can't afford bread. Borrowers may cheer at first, but everyone loses when the currency itself dies. The problem isn't just numbers, it's survival. Footnote: hyperinflation provides temporary relief to debtors but devastates the broader economy. 8. Actionable takeaway. So where does that leave you? Learn the rules of lending. Understand how inflation tilts the game. Don't assume debt is your enemy, but don't bet your future on a currency collapse either. Manage risk. Keep some cash. Own some assets that inflation can't easily erode. And above all, remember, debt is just borrowed time, priced in borrowed dollars. Footnote: awareness and balance are the best defenses against both inflation and debt risk.